Angus Geddes, the founder of Fat Profits, really opens the door on two very important changes that are going to take place in our business community. The first is that when you're starting a new business, in the old days you did it with newspapers and perhaps television, now you do it online and it's a lot more effective. And of course his own business is an online business. He's providing research material and those similar products online. 10 years ago, people doing the same thing would have used a paper-based system and it's far more expensive. Now the second change is very dramatic. We've watched carefully the big rise in self-managed superannuation funds, but that trend is going to accelerate and accelerate a lot. And as a result, you're going to see people leave large companies and start up as a rival to Fat Profits. And Angus is saying, well, I welcome the competition. And of course, if you've started earlier, you are in a better position to meet the newcomers. And of course, Angus and Fat Profits did it twice. They started in Australia, very confident, and then went off to the UK. It took about 3 or 4 years to win in the UK, and they almost pulled out. It's a lesson that if you're doing something new, it does take, or very often does take, 3 or 4 years. So let's go to Angus Geddes. Angus, you started a newsletter and funds management business from scratch. What's the secret of starting a business from scratch?
Well, I think one, you've got to have a pretty good vision in terms of where you want to take your business. As they say, 1% inspiration, but I think that 99% of it's perspiration. You've really got to be like a pit bull, and hang on to the vision, and really try to sort of stick to the road in terms of where you're trying to take the business, because it's not easy, and there's going to be a number of hurdles that you have to get across along the way.
Cash is always important too, isn't it?
Cash is very important. Very important to to make sure that you've got enough cash in the bank when you actually set the business up. But also, as somebody once said to me, always make sure you've got a little reserve stashed away somewhere, because you don't know quite when you're going to need it. And I think certainly in our business, where we're quite sensitive in terms of the stock market, and the stock market can change, you've got to carry quite a lot of cash.
You started in the .com crash, or just after it. Did that help you, or did it hinder you?
Look, I think initially it hurt us because what we found was that it was a lot harder to make sales. Our sales actually halved after September 11, which was when the whole thing was really beginning to unwind. But then it actually helped us, and it was easy. It made things a little bit easier. We were able to get advertising space and advertising inventory for a fraction of what we were paying before, when the economy was going really well.
How did you market the business then, and how do you market it now?
Well, we essentially took out a number of full-page ads in newspapers. We were fortunate enough to be able to buy some distressed advertising, and we were able to sort of really hit the ground running with a major impact. But then as the advertising, the online advertising space became a lot more sort of sophisticated, we migrated from print to online, and that's really how we sort of grew our database.
So basically, after that initial burst, mainly online?
It's mainly online, yeah. From about 2005 onwards, we've pretty much only advertised online. All our products are online. We don't actually produce too much paper.
That substantially reduces your cost, doesn't it?
It substantially reduces your cost, yeah. And we found that with say print-based advertising, if you're trying to build a brand that way, a reader will pick it up, screw the newspaper up, throw it in the bin. It's tomorrow's fish and chip wrapper. Whereas online, you've got a much better. It's much more effective. You can capture the email address or whatever, and you can build a database, and you can recycle that, and you can build that up into quite a substantial database which you can market to over time.
Angus, you used the title in your business, Fat Profits. How important was that? It was an unusual name.
I think it's very important. What we tried to do was really come up with a name which we wouldn't have to spend hundreds of thousands of dollars, advertising every year trying to teach people what we actually did. We wanted a name that people would hear, that it would resonate clearly in their memory, where there would be good recall, and something that was associated with what we're trying to do, which is actually we're trying to make fat profits in the markets for our clients. We don't always succeed.
Do you think of it in the shower?
Actually, it was literally around my dining room table.
Okay.
And we had 10 names, and one of them was market profit, and I sort of said, maybe we should call it fat profit or fat profits, and we were sort of laughing, thinking, no way, it's too irreverent. That wouldn't go down well in the financial community. And then speaking to our advertising person, he said basically you've got to run with the name Fat Profits, because it stands out.
Most of your clients are self-managed superannuation funds?
Most of them, yeah. We pretty much have I would say mainly a retail audience, but there's a lot of DIY superannuitants, sort of an elderly demographic managing retirement savings.
And how do they use your business?
Well, mainly in two ways. One, they either subscribe to one of our research products, which helps them manage and invest their own portfolios, or they'll give us the money themselves and we invest that for them, and manage a portfolio of shares in an SMA along the lines of the fat profits ethos.
We've seen a huge rise in the number of self-managed superannuation funds. What do you think is going to happen in that market? How do you see the funds management business in the next, say, 2, 3, 4 years?
Look, I'm very positive in terms of the outlook. I think that that's only going to continue that trend. We have a very sophisticated retail investor in Australia, and I think the compulsory superannuations really underpin that. And I think that the whole DIY superannuitant market is only going to grow. I think there's probably going to be a bit more scrutiny over managed funds. People are more and more willing these days to actually run their own portfolio of shares and manage it themselves.
That's going to put an enormous pressure on the big players, the banks, the AMPs and those sort of things.
Look, I think that the market is going to become increasingly diverse. There'll be more and more variety in terms of different product offerings out there. And we've already seen that. In the last 20 years there were a handful of fund managers. Today there's many. You've got the boutiques, you've got the larger ones. And also I think that in terms of the industry and the way it's made up in terms of product range, that's going to continue to fragment, and you'll get all sorts of different products coming onto the market in the next 5 to 10 years.
You took your business to the UK. What was the difference between Australia and the UK, and would you advise others to do the same thing?
Look, I think that to answer the first question, what's the key difference? I think Australian investors generally are more sophisticated than British investors. There's a much greater willingness to invest your own money and manage a portfolio of shares in Australia, and indeed take a risk. And I think maybe that's partly cultural, but also I think it's got a lot to do with compulsory superannuation. Investors, the average Australian today, they've been working for 20, 30 years. They're sitting on a sizable sum of money which is invested. So they're interested. They're interested in terms of the financial markets and the stock market in terms of what's going on. Whereas in Australia, in the UK, it's not compulsory. There's a much more tendency to use managed funds as opposed to direct shares. And I would say, generally speaking, investors over there are probably a little bit more conservative in Australia. And just to answer your last question, we did find it difficult to get traction in the UK, probably for those reasons, in the first few years. But it's a wonderful space to be in the UK once you've got that traction, and once you've actually got that brand awareness and you've got a following.
Do you make money over there?
We do now, but we didn't for many years.
Okay.
We had Red Ink for about 3 or 4 years.
Did you think about pulling out?
We did. We nearly thought about throwing in the towel on a few occasions, but it comes down to that pit bull mentality. You've kind of really got to stay with it and see it through to the end. And it's the old saying, sometimes it's darkest just before the dawn. And we sort of had a breakthrough year about 3 years ago. So we'd been over there for 4 years losing money, and then all of a sudden we sort of got that traction.
Do you think that as people understand the structure of fees, it will change the way they invest their money?
Yes, I do. Specifically, we're in the separately managed account, managed discretionary account business. That's our funds management model. And I think, moving forward, a lot of retail investors will be, a little bit more scrutinising over what they're paying away in terms of trails, commissions, the fees that they have to pay on a wrap platform versus, say, a DIY structure. So I think there'll be a lot more awareness. I think that the fees, generally speaking, will become a lot more competitive, and I also think that investors are probably going to want more transparency.
You might see more people leave the big funds and start competing against you.
Well, that's what we think, Rob. That's what we're sort of thinking.
But are you frightened by that, or are you encouraged by it? That you get more rivals out of the big groups?
No, look, I'm not rivaled. I actually think that it's a good thing, because at the end of the day, it's going to grow the market. It's going to expand the market, and that's going to mean more business for all of us. And we saw that in the independent research market. A lot of players have come into that space. It hasn't really damaged us in terms of market share, but or overall profitability. But I think it's actually grown the market, which has been a good thing.
Are you a bull or are you a bear?
Well, it depends on what asset class we're talking about.
Shares.
With equities, look, I am bullish. I think we've been through one of the defining events in financial markets in the last 70 to 80 years with the GFC. I think that the long-term fundamentals for Australia are very, very sound, and right now we're pretty much fully invested with our portfolios. We're carrying very low cash levels. See a lot of value out there, so I think the markets are going to do very well over the next few years.
Are there some markets where you're bearish?
Yes, some asset classes.
Yes.
And some equity markets. I think the US equity market, for example, won't do as well as Australia and Asia. I think that's where the centre is really going to shift, over the next few years. But certainly fixed interest. Bonds have been in a bull market now for, 30 odd years, and I think that that's not going to be the case going forward. So I'd be very careful about, putting my money into 10, 20-year fixed interest.
You think interest rates are going to rise, in other words?
I do, yeah. I think we're going to get a lot of inflation globally in the system, and that will be detrimental to bonds.
Thanks, Angus.
Thank you, Rob.